Hey guys, it is Julie here with JT.Wealth. In today's video, we are going to discuss understanding your tax bracket. So let's get into it. All right, guys, welcome back and thank you so much for being here. Like I said, today we are talking about taxes. And I know that is not a fun or exciting topic, but it is one that I think is very important to understand. There can be a lot of misconceptions out there surrounding tax brackets and rates. The most common one being that if you move to a higher tax bracket, you can actually end up taking home less money. I've heard people say that they're not going to take on any more shifts or work any more overtime hours because they're afraid of moving into that next tax bracket. But that is not the case. So in today's video, we are going to go over what a progressive system is and a marginal tax rate. And just before we get into all of that stuff, this is just your friendly reminder that if you enjoy this video, make sure you hit the thumbs up and check out some of our other videos on our page. Don't forget to check out the description below, which has a link to my Patreon page and some great referral links. If you're looking to start a new investment account, Webull is offering 3 free stocks right now for just opening and making your initial deposit, so check them out. Okay, so let's talk taxes. Here in the United States, the federal income tax system is progressive, meaning that different tax rates apply to different portions of your taxable income. Now, the term tax bracket refers to the highest rate paid on your top portion of taxable income. Now, in 2020, income was taxed at 7 different rates. And those rates ranged from 10% at the very lowest up to 37% on the high end. But these are marginal rates, so it's important to keep in mind that these rates only apply to a specific portion of your income and not your total income overall. So let's take a look at a simplified example of how this works. So let's say that the government has 3 marginal rates set up like this: 10% on $0 to $20,000, 20% on $20,000 to $50,000, and then 30% on $50,000 and above. Now let's say that your income was $75,000 for the year. That would put you in the 30% tax bracket. And people's first reaction is, oh my God, that means I'm paying 30% on all of my income. But that is not the case, as we said that those marginal rates only apply to a specific portion of your income. So the first $20,000 is taxed at that lower 10% rate. The next 30 is at the 20% rate. Then the final 25,000, so just the portion that is above that 50,000 bracket mark, is going to be taxed at the 30% mark. So your total tax paid is actually $15,500, which actually works out to 20.7% of your income, not 30% like your bracket. So that 30% rate is your marginal tax rate, which means it's the highest bracket that applies to your taxable income. That 20.7% we call the effective tax rate, which is actually the average tax rate you're paying on your total income. A simple way to remember it is that the first dollars you earn are taxed at the lowest rate, and the last dollars you earn are taxed at your highest rate. And there are always adjustments being made to these tax bracket parameters, and it's the IRS's job to adjust income thresholds to keep pace with inflation. For example, in the year of 2020, for a married couple filing a joint return, that top rate of 37% only applied when their income went over $622,050. For single taxpayers, the thresholds were lower. One more common myth that I want to address is surrounding bonuses, and that you pay more taxes when you're being paid a bonus. Now, that myth is stemmed from the fact that the IRS has special rules on how taxes are withheld on bonuses. And most companies take the easy route and just withhold 22% for federal taxes on their employees' bonus. So some people think that this means they're paying more in taxes on their bonuses because their usual federal tax withholding from their paychecks is much less than 22%. The key difference is that 22% is withheld, not actually paid in taxes. While more money is withheld from your bonus, the actual tax you owe is calculated when you file your tax return. So you then apply the money that was withheld or paid in estimated tax payments to calculate whether you receive a refund or owe money at the time. If more money was withheld than you owed, you get a refund. So don't worry about being ripped off on your bonuses there, as it does all get worked out at tax time in the form of that refund. So that is just a quick refresher on how the progressive marginal tax rate system works. Those are some very common misconceptions I've heard over the years, and I'm sure there are many more out there. So I would love to hear from you guys. What other tax myths have you heard, and how do you feel about moving into a higher tax bracket? Leave it down below in the comments. You know, I always love hearing from you. If you made it all the way to the end of the video here, you better give us a big thumbs up and make sure you go check out some of our other videos on the channel. Thank you so much for watching. I hope you have a fantastic day, and cheers!